The Federal Reserve is raising its key interest rate 0.25 percentage point, underscoring central bankers' commitment to fighting inflation even if that heightens the financial pressure on the country's banks. The Fed's benchmark rate is rising to a range between 4.75% and 5%, the bank's rate-setting body said Wednesday in a statement. That's the highest level for the federal funds rate since 2006. The sudden collapse of Silicon Valley Bank on March 10 and of New York's Signature Bank 2 days later has spurred fear that worried depositors could rush to withdraw their money from other regional lenders, sparking a wider crisis. Bank wobble leads Fed to back off. As recently as 2 weeks ago, the Fed appeared set for a steeper rate hike and prepared to keep them elevated for longer. But a startling deposit run at Silicon Valley Bank, closure of 2 smaller banks and takeover of 2 others created panic in the financial system. Many economists, as well as the Fed, noted that banks' newfound caution following the turmoil would likely drag on the economy. Silicon Valley Bank and Signature Bank were both brought down, indirectly, by higher rates, whose rapid rise hurt the value of the Treasury bonds and mortgage-backed bonds they owned. As anxious depositors withdrew their money en masse, the banks had to sell the bonds at a loss to pay depositors.
This afternoon, the Federal Reserve raised a key interest rate by 1/4 percentage point despite the recent turmoil in the banking sector. The central bank did signal that its streak of rate hikes to battle inflation is nearing an end. CBS's Caitlin Huey-Burns has more from the White House.
Announcing today's rate hike, the 9th in over a year, Federal Reserve Chairman Jerome Powell said inflation remains too high.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Those costs continue to soar, with consumers now paying 7% more for a gallon of milk, 20% more for bread, and 110% more for a carton of eggs than they were a year ago, all costing American households an average of $372 more a month. The rate hike aims to tame this kind of inflation, but it also means paying back your debt will be more expensive. On Capitol Hill, high inflation and the recent banking crisis have made the Fed and its chairman a target.
The Federal Reserve will never get control of inflation without hurting a lot of people and putting a lot of people out of work unless Congress helps on the fiscal side.
Powell also said today that the U.S. banking system is sound and resilient, but he also acknowledged the need to strengthen regulation and supervision of the banks. As for criticism of the Federal Reserve, the White House tells us President Biden is confident in Chairman Powell. Nora?
Caitlin Huey-Burns at the White House. Thank you.
Recession coming? The Fed's latest policy statement signals its shift from fighting inflation at all costs to a more delicate balance between trying to bring down prices while tightening credit in ways that might further sap public confidence in banks and hurt the economy. A dovish rate hike was delivered from the Fed today as they attempt to balance the risks of price stability and fighting inflation, Charlie Ripley, senior investment strategist for Allianz Investment Management, said in a note. Not signaling a higher terminal rate should send a message to market participants that the economy may be weaker than recent economic data suggests. But with economic growth already subdued, even the small rate hike risks tipping the U.S. into a recession and driving the unemployment rate higher, economists said.